Welcome to the TrestleBridge Capital Market Observations Call for the week of January the 17th, 2023. I'm your host, Eric Jefferson, and as we kick things off here, have a few quick words from our legal team. With that, can go ahead, get started. Hope everyone enjoyed a long weekend. Markets closed on Monday to honor the late Dr. King. And speaking of markets, that caps a two-week, a very strong start to the year. S&P 500 north of 4%. We've seen bonds stage a fairly modest rally as well. And the catalyst for risk on has been progress on the inflation front. Last week, we got CPI, Consumer Price Index data suggesting that year-over-year inflation decreased to a rate of 6.5% in the month of December. That was slightly better than expectations. That obviously represents a good bit of progress from the 9% rate that we all felt and suffered through in June of last year. That lower inflation data sort of caused or created hope that the Federal Reserve will now be able to back off their pace of future rate hikes and engineer what was referred to as a soft landing, or again, a way to slow the economy in an effort to cool prices without necessarily sending us into a recession. Now, from my seat, I certainly understand the rally here following some encouraging inflation data, but do think there is a little bit of a disconnect between where the market is trading and what the underlying fundamentals suggest. Long term, we think about two things that ultimately drive stock prices. One are earnings, and earnings growth certainly showing some signs of slowing down. At this point, no idea what magnitude or what level that will be, but certainly some negative leading economic indicators. We also kicked off the Q4 earnings season last week. Heard from a lot of our banks, and the results were uninspiring to say the least. A majority of folks calling for a mild recession as their base case. When we think about inflation and ultimately the role or impact that it has on interest rates, yes, inflation certainly following has made a tremendous amount of progress. Granted, do still have quite a ways to go. The one component with inflation that gives me a little pause is the stickier services sector, or segment rather, hasn't necessarily progressed nearly as much as the Fed would like. The Fed has come out time and time again, reiterated their goal is to get inflation down to 2%. There's absolutely no way that happens without very meaningful progress on the services CPI. And again, haven't really seen any meaningful advances to suggest that target is in line anytime soon. As we think about the resulting Fed policy, market expectations are for two more additional rate hikes, February and March of this year. Then anticipate the Fed to pause before ultimately cutting interest rates 50 basis points towards the end of this year. In my opinion, I think there's a fairly big disconnect between what the market is currently pricing in and what the Fed has come out time and time again reiterated. They anticipate holding rates higher for longer. Again, I think it's also very difficult to envision what scenario where they would actually be cutting rates. And again, it's the market's anticipation of those rates being cut later this year that in many ways has fueled this rally. If we think ultimately the two things that would allow the Fed or motivate the Fed to cut rates, one would be if inflation dropped down to 2% very quickly. Again, I think there's a very, very low probability of that. The second would be if this recession turns out to be worse than expected, the Fed needs to come in, inject some emergency stimulus to help revamp the economy. Certainly that's not the base case, but if that's ultimately what played out, not an environment where you would want to be owning risk assets. Additionally, on the geopolitical front, something that, in my opinion, hasn't gotten nearly as much headlines as it probably deserves. Treasury Secretary Janet Yellen came out over the weekend indicating that the U.S. would hit its debt limit this week. As a result, they would then enact what is referred to as extraordinary measures. That gives them access to capital, which would likely fund our federal government through the summer, possibly early fall. But at that point, would require our elected officials to come together to an agree to ultimately raise our ability to borrow more capital. Again, as we know in Washington, with the polarized leaders in place today, very little that they can agree on within their own parties, never mind coming together as a group. That's something, if not done in a timely fashion, as history would suggest, could translate to some very volatile periods. So something still several months out, but certainly on the radar, given the track record of our two political parties working together and ultimately the consequences or potential impacts that could have on markets. That's all for this week. As always, happy to discuss anything in more detail. If you don't connect, have a great rest of the week. Take care.